Well, good morning. Welcome to the Open here on BNN Bloomberg. We have some breaking news on the Canadian economy. Inflation data just crossing, and it looks like inflation ticked back above the Bank of Canada's control range in July. But weakening core measures do point to a cooling momentum in price pressures. Let's go through the headlines. The Consumer Price Index rising 3.3% in the month of July compared to a year ago. That's the first reacceleration since April, based on the data we just got from Stats Canada. That is faster than the median estimate for 3% in a Bloomberg survey of economists. On a monthly basis, we did see the index rise 0.6%. That was double the expectations. Now, just going deeper into the data here, two key yearly inflation measures that are tracked closely by the Bank of Canada, which are the so-called trim and median core rates. Those filter out index components with extreme price fluctuations. Those dropped, averaging 3.65% from a downwardly revised 3.7% a month earlier. So that matches expectations. You have a 3-month moving average here of the measures that the Bank of Canada Governor Tiff Macklem has flagged as key to his team's thinking, falling to an annualized place just below 3.5%. The numbers highlighting a challenge in the current phase of the inflation fight after what some would describe as some favorable base effects, which lent a helping hand to the deceleration in recent months running their course. July's reacceleration in that headline inflation rate, mainly due to gasoline prices, as a large monthly decline 1 year earlier, is no longer impacting the 12-month movement. We know that Tiff Macklem and Bank of Canada officials already anticipated consumer price gains would remain near 3% for the next year, previously saying last month that the next stage in the decline toward the 2% target is expected to take longer and is more uncertain. So at the end of the day, the latest inflation print, at least with those cooling core measures, could pave the way for policymakers to return to the sidelines as early as their next meeting on September 6th. For what it's worth, the majority of economists on Bay Street currently expect the central bank to hold interest rates steady at 5% next month. Let's get some immediate reaction to the Canadian inflation numbers. Philip Petursson is Chief Investment Strategist at IG Wealth Management, and he joins us here on set. Great to see you.
Good to be here.
How do you feel about the inflation picture in this country right now?
I think it's fine, actually. And to be honest with you, the 3.3 print that came in is somewhat as expected. We thought that inflation would come in a little bit higher, and this is because of the base effects. You're dropping off some really low numbers in the back half of last year that is going to make inflation look like it's accelerating, but in reality, it's not. It's taking on really, really tough comps from a year ago. And think about it. The back half of 2022, I think on a monthly basis, saw inflation rise by 0.2%. In the fourth quarter, it was flat. So anything above that is going to show that inflation seems to be ticking higher. But is it really? Now, in some cases, yes, gas prices are a little bit higher, but a lot of other categories, prices have actually come down. And we expect inflation to moderate through, I would say, the next 6 to 12 months. But look, we're not going to get back to 2% immediately.
You know, it's interesting when we're talking about inflation, which inflation story are we talking about is another consideration for anyone who's trying to figure out the path ahead. Grocery prices seem to increase at a slower pace year over year, but services inflation, which a lot of people have been talking about because people are getting out and traveling, that rose more than 4% in July. On a monthly basis, you saw higher prices for travel tours leading the gain, July being a peak travel month. And then, of course, the irony of higher interest rates to fight inflation playing a role in mortgage costs, the mortgage interest cost index posting another record year-over-year gain and remaining the largest single contributor to the headline rate. So you take a look at those numbers and think what?
I think the Bank of Canada should pause. I think when you look at those numbers, my inflation is going to be different than your inflation. That's going to be different from someone else's. If the Bank of Canada realizes that some of the biggest components to inflation is what they're doing with interest rates, then they should no longer be raising rates. We have the overnight rate at 5%. If inflation's at 3.3, that means the real rate's just about 2. That's pretty punitive as far as the economy is concerned.
Now, we do have this report, the last of 2 inflation reports before the next Bank of Canada interest rate decision. Your view is no need to be more aggressive with rates. It looks like many on Bay Street are expecting that right now. But what do you think the Bank of Canada is ultimately going to be navigating when they make that decision?
It's a tricky question. I mean, you saw what happened earlier in the year where it looked like they paused and then they did an about face and raised again. I think what they might do at this point is talk inflation down. So there's always the threat that they can raise rates a little bit higher. But look at some of the other economic data. You know, GDP for June didn't come in exceptionally strong. In fact, came in weak. If you look at the labor market, it's starting to show signs of weakness. So what the Bank of Canada wants, I think, is starting to happen. So I think they can just sit back for now.
So everybody's been zeroed in on the inflation story, but as interest rates climb and ultimately stay higher, a lot of people are worried about the recessionary risks from that. How do you, and especially for the Canadian economy where we're so deeply tied to household debt, how do you feel about the economic outlook from here?
I think there is an expectation of moderation over the course of the next year. I think recession is a potential, and perhaps the risk of recession over the course of the next, say, 12 to 18 months could be above 50%. I think that's very realistic. You haven't seen a central bank in Canada or the United States raise rates to the extent that they have without the natural outcome being a recession. So it has to remain top of mind for investors that there is that potential. We need to weigh the potential for a recession against valuation in the markets and the earnings potential of companies themselves.
Okay, since you are talking about valuations, let's talk about the broader market view on what's happening right now and how you're strategizing around that. What's been the conversation you're having with clients these days?
Well, we've been focused on managing the potential for downside risk. That is, if we see a recession in Canada or we see in the United States, then how do you mitigate or protect against that? And one of the ways that we've been recommending is by focusing on cheaper areas of the market, also focusing on bonds. Look, if interest rates are at the level that they are, where bonds now are being offered at 4.5%, 5%, upwards of 8% for high yield, that's advantageous for investors. That locks in an income that is perhaps commensurate to what we could expect for equities with much less downside. On the valuation side, despite the market continuing to prove us wrong, we have trimmed our U.S. equity weight because this is one of the more expensive areas of the world. And so we just want to protect ourselves against that downside risk.
So in the U.S. today, there was retail data that showed consumer resilience. We're also watching not just the North American economy, but what's happening in China, where they are dealing with a whole host of issues right now, not just on the recovery story, but some debt issues, a surprise decision on rate cuts in China as well. And I think a lot of people are trying to figure out what that means for the global economy. When you try to think about investing with some of these big headwinds globally right now, what goes into your thinking?
It comes back to what are the downside risks. And the downside risks are that if you have the second largest economy in the world that's slowing down and struggling to get growth kickstarted, that is going to impact the rest of the world. We've seen that with their import data and their export data just last week. That tells us a lot. And so you couple that with some of the recessionary risks that we see in North America, it continues to suggest being a little bit more defensive within our portfolios.